What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is June 3rd of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we've got a lot of things to discuss, but we've got to focus in on the crazy sense of price action we've had over the last 48 to 72 hours as Bitcoin not only broke above the 5-digit level of $10,000, rallying up to around $10,600, but then coming crashing back down to around $9,500 in just about the same period of time. So I want to go ahead and talk a little bit about what causes these kinds of events in regards to price action, as it speaks to a systematic problem with the cryptocurrency space at the moment. But outside of that as well, dive a lot into the data as to why right now precious metals are really stealing the center stage. We've got a lot of things to discuss throughout the video right after our quick sponsor. Our sponsor for today's episode is TaxBit. The IRS recently released new forms in 2019 that require all taxpayers to attest to whether or not they traded cryptocurrencies, no matter if they made gains or losses. TaxBit automates your cryptocurrency taxes, enabling you to effortlessly track, calculate, and report your transactions. Easily connect your exchanges to securely sync your transactions and run them through TaxBit's tax engine. Generate your completed tax forms with a single click. Founded by tax attorneys and CPAs, TaxBit is the most trusted cryptocurrency tax solution. Get 10% off your tax plan today with a free trial using promo code DATADASH. Alrighty, everyone, so let's go ahead and spend some time to take a look across the board for cryptocurrency markets. As we can see, the vast majority of cryptocurrencies have fallen into red territory as Bitcoin has started to sell off. Currently, right now, on CoinMarketCap, we're reading that Bitcoin's down 5.42%. But honestly, this isn't too scary. It's basically just about where we were back on June 1st. So this is the first thing I always try to emphasize to people when they see these kind of drops in regards to price. Just like, for example, when we see these kind of moves up, to understand that a lot of price action coming in quickly into any market, whether it's Bitcoin, stocks, commodities, you name it, it's usually going to come back with some form of pullback. Now, that's what I thought this was right here. I thought that was the general pullback after we had a really great rally from 9,500 going to a full peak of around 10,400, and then coming back down here towards around the big even to make support on that level, but also to, again, cut back on some of the gains. It's usually what happens in any kind of bolster or rally in prices. And afterwards, we started to get a tick up in price. And I think just to pretty much justify anyone's take of the time, it would have been understandable to be bullish back here. And out of nowhere, within a matter of just an hour in price, really less than an hour, in just a couple of minutes, we saw a pullback all the way down here to around 93 to 9,500. Now, this is a pretty stark drop here in Bitcoin's price, right? We saw a drop down here within a matter of just about an hour of nearly 8 to 9%. This should be red, of course, but considering that, I mean, that's honestly, understandably a justifiable concern here when it comes to crypto markets. So how can something like this happen in such a short period of time? I think it's a very good question, and I want to go ahead and try to explain a little bit about what might have happened here. So first off, an important thing to note here is that when you get these kind of price moves in the market, especially when it comes from a concentrated set of buyers, you don't always have what's known as the support from the order book, okay? So think back here, for example, right? The general range that prices have been trading around between here on May 28th here to June 1st. Over these 4 days, we had prices trading a general range around 9,400 to 96 to 9,700. Pretty consistent price range, and because markets were trading in that range, it probably means that on both sides there was a pretty steady order book. There was a steady order book of buyers, steady order book of sellers, and in this case we had a clear through. So in coming through and buying up a lot of Bitcoin, in fact, just here on Coinbase, over 12,239 Bitcoin, coming in and buying up a lot of Bitcoin, clearing through the asks on the order book. And this happened across all exchanges, and it probably wasn't one trader, it was probably multiple traders, of course. But afterwards, on this case, we don't have the order book probably consistently adjusting. Some traders have automated systems on adjusting to the times. However, if enough sellers come in, like we saw here, it can clear easily through the very thin order book that there is. And you can see that in this case, we had over really the first hour here where the dramatic sell side action came through to correct on this price action, a lower amount of sell side volume than what we get on the buy side. So it's important to notify that in regards to the kind of price and the volume side of things. How, again, the order book didn't come up clearly to adjust. Now, let me be completely honest here, guys. Why did it go vertical like this? I understand. Why would someone be selling, for example, 7,500 Bitcoin right after this kind of move, right? Wouldn't they just sell it on OTC? when they sell it at a slower pace rather than doing this? Yes. If they were just a normal seller doing that, they would just sell it probably through OTC. They would probably just do a slower trade over time or take a partial share on the order book on the way up. This was directionally and purposely caused, as it is many, many times. As you've probably heard before, it's the infamous Bart chart that we've been hearing so much about. It's been prevalent in the crypto space over the last few years, and it's a symptom of people overtly trading on leverage trading platforms, on derivatives platforms that are exposing themselves to high levels of leverage that give them an incentive on an illiquid spot market to go out and manipulate price. That's exactly what happens. Now, in the long term, in the sense of like longer term moves and larger kind of trades in the space, it's a lot more difficult for these kind of whales who are competing against one another to do this. So it's kind of interesting. It's a phenomenon that we can kind of watch in the short term as passers, just kind of passengers in this crazy ride for the cryptocurrency movement. But it's a reality of it. To be fair, there are too many people who are trading on derivatives platforms and not enough liquidity on the spot exchanges where the derivatives platforms get their indexes for price. So again, it gives a really ill incentive for people who, for example, might have the majority of their holdings on a leverage trading position, where they're up on 3 or 5x margin, long or short, meaning that they're betting on the price going up or betting on it going down, and then they just manipulate the spot markets. I think that's exactly what's happening here. It's been what's been happening for the last few years, so it's nothing to really fret about in price. As you can see, the order book here has corrected us back to where we should be, right? And that's why you get so many of these Bart charts, whether it's a downward move and a move upward to the upside. It usually corrects back to the normalized range for price. So again, the only problem that really comes out of this is what we saw back on in the early phase of March, where we saw the massive sell-off. That was nearly directly caused by overt leverage on derivatives platforms and also potential sell-side pressure for things such as the Plus token Ponzi scheme, which was dumping a lot of its crypto holdings. Now, I want to go ahead here, dive in a little bit into taking a look here at altcoin dominance. Even though the sell-off was quite dramatic yesterday, altcoin dominance rallying to relative highs here since all the way back here in April of 2020. So nice to see that we're continuing the uptrend here. We're going to be testing up towards that line of resistance that we tested 2 times in the past, seeing if we can get above here, and then looking for our next target range to break above the yellow line, which is, in the end, our target goal for starting the altcoin cycle. Getting above here, making it support, and breaking out. But again, I think it's just important to constantly revisit this. It's nice to see this kind of steady price action here. And again, altcoins coming through nicely. Now, I want to go ahead and talk about a few other things here. One key play that stood out yesterday was NEO. NEO came out with some interesting news. Again, we were talking, we kind of alluded to it yesterday. NEO definitely showing some positive price action and volume, some continuation from already pretty positive price in the market. But this comes in after an announcement of the Interwork Alliance. So this is something that came out from NEO yesterday. Da Hongfei tweeted out about it, that they are proud to be working alongside a cohort between Microsoft, Accenture, SDX, and Digital Asset to basically initiate this creation of the Interwork Alliance. So the whole philosophy here of the Interwork Alliance is to work with a wide range of different corporate entities in order to build a blockchain-based network, the developing tools, a lot of other systems in order to actually scale out blockchain development to a wider audience. Right. So again, as I've mentioned before, there's a lot of people within the NEO ecosystem, one of them being John Devidas, who I know personally, who previously worked at Microsoft for many years. And again, has been able to kind of bring in, I think, a lot of the traditional, infrastructure and a lot of the companies from the tech sector in regards to, Seattle, inside of, the Valley, inside of California and Washington, and being able to bring that to the forefront for the NEO blockchain. So it's really awesome to see this. I think it's a very exciting announcement. They also have as well a webinar registration that they shared on their Twitter page. I think this is the tweet here, the link to it. So I'm definitely considering checking it out. I'm interested because I'm a big, I'm interested in a lot of things. I'm interested in the EEA. I'm interested as well in systems like this that have a very strong kind of emphasis on working with corporate entities within the blockchain ecosystem and continuing to expand more competition in the protocol space. I've talked about the protocol wars for a long period of time. I want to see more competition. As much as we love Ethereum, I want to see interesting developments on Neo and a lot of other blockchains, as we talked about Cardano the other day. And it's just a matter of building these alliances, working with traditional infrastructure. So I'm very excited to see what they come up with. Now, in the sense of traditional markets, I want to talk a little bit about gold markets because, again, I've emphasized over these last 2 years, it's become more and more confident, guys. I become more and more confident personally that this is the time for precious metals. And there's a lot of interesting charts here that I think are going to signal that. So here is a really interesting chart. This is the GSCI. This is basically the global commodities index against the Dow Jones Industrial Average. So it takes a weighted average of commodities and their performance against the Dow Jones. And as we like to do on the channel, build a ratio. We like to build ratios here. That's one of our, I think I'm going to make a t-shirt on that. We love ratios because that is something we use a lot here on the channel is just looking at the general kind of ranges where you start to see optimism or bearishness. Basically maybe, for example, an asset is overvalued. Maybe undervalued in this case. And we can see now, right now, against commodities to the Dow Jones, that we're back down to levels we haven't seen since back here in the 1960s. It's been decades, nearly 60 years, since we've been down in this range. And it's very, very important to understand this when you're determining, what asset class you're going to mainly expose yourself to over the next few years. As a macro trader, if you're a macro trader like myself, that's an important question you should be asking. You're going to have to determine the answer for yourself, but I can go ahead and just show you a few charts that make me personally confident on not only gold, but silver and precious metals as a whole. Now, taking a look at the Dow Jones to the gold ratio. So this is again another ratio here where we're taking the performance of the Dow to gold in this case, and we can see here that as the price is going up here, this is when gold is setting a low and stocks are hitting a high, and vice versa. In this case, when we're down here, gold is setting a higher level and stocks are heading towards lower levels. So we can see here that we set back our high back here in the 80s, and really ever since, not even back here in 2011, we really haven't started off, really the per se, we haven't hit a new high for gold down here. We never did that back in 2011. Really, we've still been at a time period where equities have been performing well. I would really compare this to what happened back here between 1960 to the late 1970s. As we get a bump up here for gold, but it still came in contact with the trend line, which now looks like we started to hit resistance here, and over the last few years are starting to come back up since 2016 to come down here and revisit and recorrect for gold against equities. This would be an interesting scenario. I mean, this chart here, I think with the consistency of the lows and the highs and the expanding channel that we're seeing, that this gives for a dramatic move of either equities, in this case going down dramatically, or probably what's probably much more rational, which is equities dropping to a decent degree eventually after central bank monetary policy wears out, and gold coming in to serve as a dramatic hedge in this environment. It'd be interesting to see. Who knows? We might just come down to a similar low down here, or we might have a dramatic stretch out, just like we saw over here against the Dow Jones. So, again, very important to see here that as we've expanded the fiat money supply, we broke out of a nice consistent trend here from the Dow Jones to gold in this case. The gold standard now expanding into the crazy era of endless printing. One thing I wanted to talk about, it's funny, even in a time of crazy printing, Fed deflation probability from the Fed, basically the Fed statistics, stating that it's nearly a 78% chance that we're going to have deflation in the economy. If you want anything to prove that the Fed is not giving money to everyday people and that banks aren't lending to people, this is your proof right here. The Fed is saying it themselves. Because if there's deflation in the economy after the largest quantitative easing program in history, you can start to understand that QE is probably not supplementing cash to everyday people. It's going directly into financial assets. And this is one of the key proof points here. It's the same back here in 2008. The Fed doesn't care about everyday people. And if they did, you'd actually start to see some inflation. You'd start to see some of that money going to everyday people. It would be a symptom of it. Sure, you get a little bit of inflation, but it's very clear that the Fed has only one priority, and that is to continue to prop up asset markets, to continue believing in the idea that somehow propping up hedge funds is going to somehow trickle down a little bit into the everyday person, when in reality, they for some reason can't provide a direct paycheck protection program themselves. That's the job of the Treasury, right? We got to put that debt on to the average everyday American, right? Physical gold held by gold ETFs picking up pace here. Now, one thing I always emphasize here is that with the ETFs for gold, they do not have a massive physical representation for every single share they issue. It's usually a 1-to-100 ratio, meaning that there's 1 ounce of gold for every 100 ounces worth of shares on the market. This is a massive issue of rehypothecation, but the general increase here shows that they are issuing new shares. And it shows that people are setting up a new precedent of demand for gold here. I would recommend, though, personally, again, I can't give financial advice, but if you wanted to know my opinion, guys, in regards to gold as an asset or silver, I prefer to own physical. I think it's worth the extra cost in this case because the risk of owning a paper product that doesn't have the physical backing, if things really go south, right, if you're looking for that hedge, paper products aren't going to be worth anything. And there isn't even much, basically, there isn't much state of ownership that you own that 1 ounce of gold for every 100 shares, or even a fraction of it. So it's very important to realize that, as you would want to realize with any asset. You want to know what kind of ownership principles you have. Now, outside of that as well, the U.S. personal savings rate has launched to a new record high. Looks very similar to the kind of spike we've seen in unemployment and unemployment claims in the United States, this kind of vertical response post-COVID-19, up to 33%. Now, a lot of this is probably coming with the Paycheck Protection Program, but also, along with that, people just simply saving, cutting unnecessary expenditures. Really incredible to see this kind of spike up here of over 33% here in April of 2020. Be interested to see what happens in May. Fed balance sheet starting to look like it's going to fade off. And this image makes it sound, the Fed bazooka is going to fade in the coming months. Thankfully, I'd hope so after already having the largest round of QE. I hope Isabel Net is on par with us with hoping that we're going to see a decline here. But this is actually a chart here from Bloomberg for the Bank of America. So I would hope the writers of Bloomberg are not calling for more stimulus. We've already had plenty. Again, I think we all realize, though, that this is what drives the system. This is what drives asset markets. And we can see that over the next coming months, we're expecting that it's going to start to wear down here, even possibly visit. These are, I think, probably the next few quarters here, looking at the years. But this still means that we've got, for example, if we're taking a look at the area we're at right now for the forecast, we've still got trillions of dollars of liquidity to inject into the system, as already planned. And I have no doubt that the Fed is going to continue expanding up programs as they've been opening up credit lines. They've started to talk about the medium-sized business program that they started back in June, at the beginning of this month. So again, lots of interesting forms of stimulus coming through. This is doing a great job for gold, as gold is hedging against this scenario, as it's hedging against the global fear right now. Gold back here since May of 2019. A year later, has rallied up here to $1,700 per ounce. Incredible to see where we've come in a year, adding just a little bit under $500 for gold. But what's more even interesting in the short term is silver's performance. Silver, after having a pretty stark correction alongside gold and other assets in the market, came down here all the way down to $11 per ounce, or around $11.69, all the way up to $17.89. And you can see here just on the going ahead and take a look at the daily here. The rally has been significant here since back in mid-March. The weekly makes it look even more dramatic coming against that sell-off. And what really matters here is the gold to silver ratio, as we've talked about. The similarities, the eerie similarities we've had with what happened back here, where as the recession kicked in, gold was the safer asset. Even though gold was pulling back, silver was losing quite dramatically. And then afterwards, as we enter into the range of QE and global uncertainty afterwards, we see here that silver starts to win out. And we've been seeing that play out exactly just like we saw in a different set of price action, but the same kind of similar opposite of, I would say it's an upside down V in this case, if you want to put it that way. Basically a sharp arrow production where valuations for gold hold out against silver, and then silver starts to kick into action, kick into high gear, and looks like, as we talked about from the chart, that silver is going to be leading the way here over the next few months comparative to gold. Just taking a look at that monthly chart. You don't need to overcomplicate it. You've got the curved line of resistance here. We broke back above here, got back above here within a very short period of time. Now it's a matter of getting above this line of resistance, making it support, or doing exactly what we did back here, just breaking through and going on through. See what happens. It's a very interesting time, guys, but I think a lot of this is very interesting. And again, if you're looking to get some exposure to both asset classes, I know many people will kind of ask me some different places where you can not only get exposure to crypto, as we talked about, which is where I'm mostly exposed right now, but also into gold and silver. I think it's a very fair interest. Well, what's interesting is one of our sponsors here, Bitpanda, not only has Bitpanda Pro, that is a nice exchange for those of you who are looking to get into cryptocurrencies, but on the base exchange as well on Bitpanda, they actually offer tokenization of gold and silver as well. So you actually can get some exposure in your portfolio to gold and silver. So again, consider checking out Bitpanda in that case. Great company. All in all, we've got a lot of interesting things going on here, guys, in crypto markets. Definitely stinks to see the sell-off that we saw, but I think, again, seeing that we've broken through now, I have no doubt that we're going to have a good chance here of continuing higher, getting above that resistance point, and actually solidifying a good close above that high range around 10,100 to 10,200, getting above that line of resistance and making it support over the next coming weeks. Anyways, I hope you all are having a fantastic day wherever you are. If you like this video, drop a like. Consider subscribing and hitting the bell icon if you haven't. And I want to appreciate and say thank you to all of you who signed up for the announcement of the startup yesterday. We had I think around 150 or 200 people that went ahead and signed up. So if you haven't already, guys, the link is down below in the description. Please consider putting your email in for that. I'm not going to spam you. I just want to let you guys know when it comes out. It's just a couple of days away. I'm real pumped to reveal it to you guys. But that all being said, thank you all so much for watching. I'll see you all in the next video. Stay tuned.